Welcome back, everyone. This week, I thought we'd do something a little fun. As some of you may know, I've been looking into other industries that I think are growing and seeing if there's any investment opportunities that appeal to me. And recently, that involved connected TV and targeted advertising and how that's a growing industry and segment of the advertising industry. And I looked into that, and then the buy now, pay later industry is another one that's expected to grow at double digit rates for the foreseeable future. And so I started exploring into the realm of buy now, pay later, and just, what do they call it? Fintech. And, well, I can't say I saw anything that I necessarily felt the urgent necessity to buy, let's put it that way. But nonetheless, I'm going to do a comparison on Tidewater versus Affirm. And you might say, why would I even do that? They're two completely different industries. They have nothing to do with one another, but that depends on what level of analysis you view it on, because you could say, as an investor seeking absolute returns in industries and sectors and segments of the market that are positively inflecting and growing and have revenue growth, and the total addressable market is widening and so on and so forth, and they both share that. And so on that level of analysis, Tidewater and buy now, offshore oil and payment processing, point of sale, fintech are part and parcel. So if you think that you can get good returns on capital deployed, then they are similar. So don't pigeonhole yourself into thinking that just because two industries are nothing alike, that they aren't also similar in other fashions. So with that out of the way, this is not a super in-depth. This is just some predominant things that cross my attention, and of course more research needs to be done before buying either one, and these aren't recommendations to short or to buy, go long, nor are these forecasting of future projected earnings or anything along those lines. This is just an overview of my analysis of the two and where things stand. So with that out of the way, let's do it. Tidewater, it's up almost 85% on the year. According to Fortune Business Insights, the global offshore support vessel OSV market size is projected to grow from $14.4 billion in 2021 to $23.6 billion in 2028 at a CAGR, compound annual growth rate, of 7.3% during forecast period. Now, it's interesting, I'm going to say as a side note, that you have the value investor types and then you have the growth stock types. And I always thought that was a ridiculous false dichotomy and that they're placeholder words, they're oversimplifying matters. But fundamentally, the average investor, let's just say, wants to buy something that's going to go up in value. And it's probably going to go up in value because their margins expand or their market share expands or something along those lines is going to grow. So that's growth. So this value investor versus growth investor false dichotomy I don't care for. Now, you'll notice I say things like TAM and revenue growth. And that's because, well, it's good enough for the tech bros, and it's good enough for them in regards to evaluating their companies. So why not overlay that to Tidewater, which is not revenue growth and TAM. I can't say I've really heard anyone discussing Tidewater talk either about revenue growth or TAM. You just don't see that. But I'm going to do that. let's view it through that lens. And in part, this is to tease the tech bros because, well, they should be interested in technology. Do you not think that offshore oil hasn't had leaps and bounds in technological innovation and implementation over the last decade? So they're heavily reliant on technological advancements and implications. And growth in an industry is what's important as well. So what other proxy synthetic indicator than revenue? Of course, that's only partially a sincere question. It's also a rhetorical question. So when I talk about, I just want you to know, shares outstanding, TAM, revenue growth, I'm going to apply those things in a non-traditional way to Tidewater. So be aware of that. So as we noted in this slide, that the offshore support vessel, OSV market, is expected to grow at a 7.3% compounded annual growth rate through 2028. Now, when I saw that, I was like, that sounds familiar. That sounds like energy drinks. And energy drinks are expected to grow at 8.4%. And I know that because I've looked into Monster. I probably should either just buy Monster energy drink at some point or stop looking at it, but I do like the company, and I'm probably upset that I never bought it when I should have bought it way back when. But they also have a similar compound annual growth rate. So some historical and projected financial profile of Tidewater. Here they provide you with revenue growth, EBITDA, and margin. Those seem like reasonable metrics to judge a company's trajectory. So revenue growth has been growing since 2021. And the EBITDA has been growing. That's a very, very common metric. EBITDA, not adjusted EBITDA. EBITDA has been growing since 2021, and margins have been expanding since 2021. So that would suggest an inflection in the industry. Now, another thing I want to talk about is shares outstanding and net income, as well as revenue. So this is a quarterly report because I wanted to get the most up-to-date adjusted weighted average common shares outstanding. And the shares have grown from roughly 40, I'll use the language of the 10Qs and 10Ks. So, thousands or in millions, in thousands. So just understand that. So 52,000 shares means 52 million shares. I hope we all understand that at this point. So they've grown the shares outstanding roughly from 40,000 to 52,000 since 2020. Okay, now remember that. So you could call that roughly 27, 28% increase in shares outstanding, something in 25, 30%. And then revenues have grown from 386 in 2020 to 361 in 2021 to 641 in 2022. And so far in the 6 months of 2023, revenues are at 408. So if you annualize that, that'd be 816, but we don't know. The Solstat acquisition, Tidewater's actually targeting slightly over 1 billion of revenue. So that means from 2022 of 641,000, 2023 will be roughly, I guess that'd be 1 million, because 1 million times 1,000 is a billion in revenue. So they've grown the shares by roughly 25%, and the revenues have grown, well, they're going up every year in solid lockstep fashion, double digits. Then They had a net loss for 2020, net loss for 2021, net loss for 2022, and as you'll see, up to the 6 months of 2023, they have a net income, positive net income. So 2023 so far has been a positive net income year. So they're going from unprofitable, defined by net income, net profit, or net loss. So 2023, they're inflecting into positive, profitable territory. All right. Fundamentals have been inflecting positively since Q1 of 2021. This is day rate and vessel cash margin through Q2 of 2023. So it bottomed out at the beginning of 2021 and has been inflecting positively. Then they're a leading OSV operator with largest high specification fleet. Now, be aware that this chart is actually somewhat misleading because, I might embarrass myself here, but I want to say that the OSV market is like 3,000 ships, and Tidewater, we'll just say, has 200 of those 3,000 ships. I mean, we're using really rough numbers here, so, and that's okay, because if you have to be super specific with a spreadsheet, you might not have enough margin of safety. So 200 out of 3,000 is a fraction of a highly fragmented market. But the portion that they do have is of a younger fleet with newer rigs. That's the technology that you might be interested in. So they have one of the largest fleets and one of the newest fleets. So that kind of positions them in the OSV market as a top performer. Now, that doesn't mean that management can't screw it up, but that means that it's not the worst. Which, hey, it doesn't need to be the best to make money either. All right, so to finish the Tidewater segment up here, if you go to Seeking Alpha, they have 7 articles written on Tidewater so far this year. And you just got your blah, sells, and buys. Not a lot of sentiment, not a lot of enthusiasm, just basic buys and sells, 7 articles written. All right. Affirm. Affirm has gone up 90, almost 97% this year, so it has outperformed Tidewater. Now, Affirm also is off of its all-time high by 89%. Now, in all fairness, Tidewater is 100% off of its all-time highs because if you were a shareholder, you went through bankruptcy and got wiped out. So I guess that's another win for Affirm. I'd rather be down 90% than 100%. Affirm is part of the buy now, pay later market. And that buy now, pay later market, BNPL, as you might know it as, is expected to grow at a 24.3% CAGR through 2030. So that's exponentially more than energy drinks or the OSV market. So that's looking good. It's looking good. And then, of course, you can divvy up the buy now, pay later market, online versus point of sale. We're not going to get into that. Now, that's probably all the positive things I'm going to say for Affirm. When I realized this is one of the most off-putting, unattractive, repulsive type behavior that I really struggle to stand for. I've come to terms with EBITDA. I really have. It just, it is what it is. I don't necessarily prefer that metric. Cash flow, funds from operation. There's things like, just like pretending depreciation isn't real or irritates me, and pretending stock-based compensation isn't real irritates me. And we're not going to get into those reasons, but I've kind of come to terms with the baseline usage of the word EBITDA. And then you have things like net income. Then you have things like operating income. That would be EBIT, earnings before interest and taxes. And then you have gross profit, which is revenue after COGS, costs of goods sold. And as you work your way up the income sheet, less and less expenses are accounted for. So you can look more and more profitable. So then you get into the WeWork dynamic of things like community adjusted EBITDA, because EBITDA wasn't enough and adjusted wasn't enough. So they just, like, how much will people put up with? And so here Affirm is using a term quite commonly known as adjusted operating income. Well, that's an interesting phrase. Like, I know what operating income is, but what's adjusted operating income? Well, let me tell you what adjusted operating income is. Adjusted operating income, calculated as GAAP operating loss, excluding depreciation and amortization. So right there, GAAP operating is EBIT. So now it's excluding depreciation and amortization, meaning that they're adding it back. So now we're at EBITDA, but they don't stop there. Then they continue with stock-based compensation included in GAAP operating loss and expenses related to warrants and share-based payments granted to enterprise partners and certain other costs. So here they are saying, like, how disingenuous and intellectually dishonest and misrepresentative by bastardizing and co-opting a phrase and then putting on this prefix called adjusted to distort and manipulate. I could really go on a tangent there, but I think you understand how I feel about it. So with that out of the way, let's look at their adjusted operating income, ignoring the uselessness of it. Their adjusted operating income, this is a big selling point that they wanted the markets to know about. They're finally profitable, asterisk, on an adjusted operating income. Now, their accounting is different. I want to say that the second quarter of the year is the end of their fiscal quarter. So they finally became profitable on an adjusted operating income basis. But yet again, I noted how Tidewater has been positively inflecting since, we'll call it 2021. That's not been the case here, and it seems to have gotten the worse in Q2 of 2023, and then the ship is starting to steer directionally in a positive, i.e. less negative direction, which is good, right? I mean, that means that maybe things are getting better. So let's not discount that. But it does make you wonder about all the people who were bullish back when it IPO'd and back in 21 and 22. Like, the numbers have been getting worse and worse and worse. Same thing with the cannabis companies back in 2017, 18, and so on. It's like they were bullish, but things were deteriorating. So the best I can tell is on a net income level, which might not be a genuine perfect way of doing it, but I'm keeping constant my comparisons and controlling for variables. Now, you could say that the comparisons I'm keeping constant are the wrong metrics to evaluate the company, and like, fair enough. So that's why you have to question the concepts in a statement as much as the statement itself. It's like, yes, he's keeping his constants, or he's keeping his comparisons constant using the same metrics, but those are the wrong metrics, and fair enough. But with that out of the way, their net loss, So year end, June 30th, like I said, their fiscal year ends halfway in the in the middle of a calendar year. Their net loss is getting worse and worse and worse. And you could say, well, as long as revenue is improving more than the net loss is, then they're heading in the right direction. You could say something like that. But they went from 458,000. I'm sorry, I'm going to get this right. Total revenue. I highlighted the wrong thing. I apologize. Net total revenue went from 1,349,000 in 2022 to 1,587,000 in 2023. So we'll call that roughly $225 million. Not 225,000. But then you look at the net loss. It went from 707 to 985. So that's more than that $225,000. So their net loss is actually eclipsing all of the additional revenue that they made from 2022 to 2023. And if you go back from 2021 to 2022, they made roughly, we'll just call it 450,000. But if you look at the net loss, they actually were doing well then. The net loss did not eclipse. So that means that things are getting worse, at least in the fiscal year comparison from 2022 to 2023. Of course, this is not being segmented into quarterly performance. And as we noted earlier, they seem to have bottomed out in Q2 of 2023. So we do have to keep that all in mind. But if you compare on a yearly basis to Tidewater, it's not looking too attractive, which means that the devil's in the details, which means now you have to go down to a more finite level and look at the quarterly comps. So revenue's not growing like how revenue's growing in Tidewater. The net losses are getting worse, not better, and they're sure as hell not in actual positive territory. And if you look at the shareholder dilution, they went from 159,000 shares in 2021 to 295,000 shares in 2023. So not only is your company losing more and more money on the bottom line, but they're also diluting the hell out of you, which is why they don't want you to recognize the stock-based compensation, because, well, why would they? I mean, after all, as a shareholder, you make money, theoretically at least, off of earnings per share, or however you want to measure it. Revenue per share, clicks per share, something per share. That's the common denominator, is per share basis. So that's a much worse dilution. So revenue's not growing as well as revenue's growing in Tidewater. Net losses are mounting, not decreasing, and they're definitely not in the positive territory like Tidewater. And then shareholder dilution is also worsening. Or you could say the same thing about Tidewater, but it's worsening worse. And then you have competition. Now, I could have done the same thing here for Tidewater, so it's not the most consistent, but they have competition, just like Tidewater has competition. The only difference is that, well, not the only difference, a difference is that Klarna is doing really well. And then Afterpay, which got bought up by Square, also has a good size market share. And then you have all these other ones in different segments, different geographical regions, and so on and so forth. And you could say that, and then when you have Visa and this and that, so many people are getting in the fintech sector that, capital chases in, there's too much capital, and then it competes profits away, and then it's the biggest bank wins, or big bank takes little bank, because you saw this in the cannabis sector. It's like you have a new industry. It's a whole arc of development. There's a new industry, capital floods in, it competes away profits, then it's a race to the bottom of who has the most staying power, which is generally the same as saying who has the cheapest cost of capital and who's the biggest, most well-backed and financed. And then you have this whole troughing period as companies go bankrupt, and then the industry consolidates. And then a decade later, finally you have an emergence. Same thing in the EV market, or the rubber boom, or the car boom of the early 1900s and 1910s, and on it goes. So the thing is that this is an ever-expanding industry, not just because the market is expected to grow at double-digit compound annual growth rates, but also because the entrants into the market keep coming in with low costs of capital and trying to undercut and underbid everyone. And then they're not even profitable with the business they get. It's like, I'm going to underbid you to get this job, and this job's going to lose me money, but I'm hoping to do it to gain market share and have enough attrition and staying power and endurance to be able to grab enough market players to one day be profitable. And it's not good. So, yeah. While on the other hand, with the OSV market, it has a higher cost of entry, plus it's an unattractive industry, plus it's not ESG friendly, and people don't want to finance it, and people don't want to explain to their LPs why they own offshore oil and not some EV battery company or this or that. And then this is going to fintech's going to revolutionize. It's just more attractive of a speech and narrative to give than offshore oil in Guyana or Suriname or Brazil or West Africa. It just doesn't sound as attractive, even though that has nothing to do with profitability and lucrativeness of the investment. People just don't like how it makes them feel, and since we live in a predominant world where it's feels over reals, not the best. Then you can see that Affirm has 29 articles written this year on it, as opposed to the 7 of Tidewater, with 4 strong buys and 2 strong sells. Now, it's also interesting to note that it's not like one company is a $100 billion market cap and the other one's a $100 million market cap. You could say that they're roughly in line with each other, give or take a few $billion of market cap. So normally the larger market cap, the more liquidity, and therefore the more attention it draws. But that doesn't necessarily explain why a firm has hundreds of percent more attention written in the form of articles, or defined by numbers of articles written, than Tidewater does. And you would think with the propensity of markets to pay attention to inflecting positive numbers on a quarter-over-quarter basis and year-over-year basis, you would think that Tidewater would have more attention for that reason too. But as we've discussed about the baggage and human propensity to chase flashy, shiny things that sound cool, it seems that Affirm still has much of the attention, even after wiping out many of shareholders by, call it, numerous tens of percent in recent times. Like the Tidewater wipeouts were years ago. Years ago. And actually has been quite a relative pleasant holding for people of the recent past, as opposed to Affirm. So with that out of the way, I believe I am done with this segment of Tidewater versus Affirm. As anyone who watches this channel might know, I'm a shareholder of Tidewater and not Affirm, and by this, I will not be buying. That whole adjusted operating income, that really rubs me the wrong way. All right, so on to the stock portfolio review and performance. But before we get into that, I saw this interesting thing. I thought I'd throw it up here, which is of the dividend yield leaders in the S&P 500, which is essentially these dark green, 21 dark green rectangles, are all companies in the S&P 500 that are paying a higher dividend yield than treasuries. So 21 out of roughly 500 companies. And interestingly enough, Devon Energy's in here, Pioneer Natural's in here, and then some of the infrastructure pipeline companies like Kinder Morgan are in here. So it's cigarettes, energy, telecom, banks, industrials, 3M, manufacturing, things like that. So just an interesting thing. I don't plan on really buying any of these. I kind of think natural gas is cheap, and I just can't see myself buying Devon Energy. I've looked at it a little bit superficially. I don't plan on doing anything though. But I just thought this would be interesting for anybody who might be interested. Tapestry, that's an interesting one. They did the classic telecom slash alcohol industry technique of lading themselves with tons of debt in some acquisition. I can't remember who they bought, but Tapestry was an interesting company that I looked at during the whole COVID thing. But I mean, Cup of Coffee Capital started in January 1st of 2023, so you will not be seeing the ticker symbol TPR in my account holding anytime soon, I suspect. All right, before, this is not the actual weekly performance, so be mindful of that. I sold all my CRE, my REITs. As anyone who follows this channel knows, I bought some office REITs, Vornado, Kilroy, and Cousins Property. I bought it as, well, I'm not going to dog on myself, but I bought them. And then I bought TMV, which is a 3 times inverse treasury ETF, essentially. I bought that both as a trade and as a hedge, and I closed out all of it. So I sold Kilroy, I sold Vornado, I sold Cousins Property, and I sold TMV. And this actually worked out a lot better than I ever thought it would have. So I lost $35.26 on the REITs. You can see here, this is a screenshot of right before I sold. So I was down 20% on Kilroy, I was down essentially 20% on Cousins, and I was down 14% on Vornado. And then, as you can see, TMV, I was up 20%. So I sold, closed it out. I ended up losing $1.78. So roughly speaking, when I bought those 3 REITs, that was roughly $180 of, I want to say, my portfolio. And then when I bought the TMV, that was roughly $180, $170, something like that, when I bought it. And it worked out amazing. So when it's all said and done, I lost $1.78. My account, as a consequence of losing $1.78, is my account lost roughly 10 basis points, 0.09%. Now you could say $1.78 on $178 is what, 1%? So I lost 1% on the pair trade. So not bad. For being an idiot, I fared pretty well. It doesn't always happen that way. So, final slide. Portfolio performance. This is where I'm at. This is the up-to-date as of the closing on Friday, where I stand with things. I bought a share of, I don't know when, Thursday, Wednesday, somewhere in there, I bought a share of Tidewater, I bought a share of Valaris, and I bought a few shares of Transocean. That's all the transactions I did in the realm of buying things. We just discussed what I sold. This is where I stand. With things popping off with the whole Palestine-Israeli thing, it'd be interesting to see what the oil markets do in the following week, and be interesting, who knows where the markets are going. Even if that didn't happen, like, where are the markets going to go? The treasuries are ripping, the yields are ripping higher. The market's down, I don't know, 10% from the highs this year. Not the all-time highs set back in end of 21, beginning of 22, but then we had a massive rally Friday. So fundamentally, I don't know. But maybe do I put a stinker bid into the markets, do a little market order come Monday morning, and top off my offshore oils, because now, as a consequence, as I've said, 33% thematic position max, 20% in a name, 30% or 33% in a theme. Right now, I believe it's 40% exposed to offshore oil. So the answer should be no, because then I'd be breaking my own rules, which technically I broke my own rules when I bought, well, choose one, Tidewater, Valaris, Transocean. So here we are. Oil fell, I think for the third time this year. It fell like close to 15% in a week. It rallied really hard for a few weeks, and then it just, I try not to curse here. So it fell a good amount in this last week, which put a decent amount of pressure on the oil names. So I bought into that weakness. Will we see further weakness? Yeah. Your guess is as good as mine. So I'll try to stay up to date with what's going on in the macro. Seems like these are quite the macro times. Oh, I also bought a share of St. Joe. I forgot about that. And I might add to the YPF. I didn't. I really was tempted to, but besides the fact that it's a tactical trade, and I'm already exposed 40% to offshore oil, to just layer on more oil, at some point it's like maybe too much concentration, so I didn't. And I'm now in 17% cash, which isn't the worst. Not the best. Actually, I was kind of surprised, even after my purchases of Tidewater, Joe, Transocean, and Valaris, to have 17% cash. But that's because of the TMV and REITs I sold. So, I mean, that gave me hundreds of dollars in cash. So, anyway, when it's all said and done, between what I sold and what I bought, it's actually a net additive to my account in the form of cash. So with that out of the way, I believe I'm done here for the week. Hope you liked this video, and until next week.